When the stock market crashes, smart money begins buying. That's not just the idea of an old holdings company CEO, it's a fact. It's what actually happens. So in today's video, we're going to lock in and we're going to go shopping. I'm going to find the strongest stocks that are now providing us with the best values for entrances because of this market dip. And the last stock I'll cover in today's video, I truly think has 10x potential over the coming years, so make sure you stick around for that. Let's start with the Magnificent Seven, these being the 7 individual companies with the highest market caps, thus being the heaviest weighted within the S&P 500. We've got Apple, Microsoft, Nvidia, Amazon, Meta, Google, and Tesla. Right now, all 7 of these companies are down very hard. We're looking at the Google daily chart, and just over the last 2 months, this stock is down over 28%. I genuinely believe you're putting yourself in a good position if you're buying any of these 7 companies right now. But let's sort them by which have the best value right now. Which of the Magnificent Seven are the best buy? The individual ratio that I like to look at the most to determine valuation of a company is price to sales. At what multiple is the stock trading versus the sales of the company? Right now, we are looking at the Google chart of this, and its price to sales ratio sits at 5 3/4. However, that doesn't tell the whole story. To find the whole story, I need to look at the entire page here, and we're also going to take into account the sales per share growth of the company. We want to find stocks that are growing and have a low price to sales ratio. So we're going to create a scoring formula that does just that. Our scoring formula will be pretty simple. We are going to take the sales per share growth over the last 12 months and we'll divide that by the current price to sales ratio. So the higher the number, the better the value on the company is. So Google's shares per sales growth rate over the last 12 months is 16.4%, and their current price to sales ratio, once again, 5.74. So doing the math, we got 16.4 divided by 5.7. That gives us a number of 2.8. That's a good starting point. That is one of the Magnificent Seven. Let's quickly perform this calculation and sort the rest of the 7 stocks to find which are providing the best value to buy during this market correction. Apple's sales per share growth over the last 12 months is just sitting at 5.4%, and their current price to sales ratio is 7.86. So let's go ahead and do 7.86. That gives us a value on Apple of just 0.69. Nice, much lower than Google though, however. Microsoft sales per share growth over the last year is at a nice 14.9%, and its price to sales ratio currently sits at 10.63. So let's divide by 10.63, gives us a value of 1.4, should put us right between Google and Apple in terms of value. For the rest of the Magnificent Seven, I will quickly click through their charts here so that you can get a visual representation of what the sales per share growth looks like and their price to sales ratio. Then I'll go perform all the calculations and I'll show you the full list. I think you get the idea of what we're doing here. Let's speed through this process a little bit so we can get to some of the more juicy stocks to maybe buy during this market correction. Here is that picture for Meta. Growth looks good. Price to sales looks pretty good. I expect Meta to be doing okay in our sort. Let's go take a look at Amazon. Another one, obviously very solid growth. Actually, Amazon only has a price to sales ratio of 3 right now as well. So I expect that one to be doing okay in our sort. Then we have Tesla. Let's go take a look at Tesla. Tesla, I do not expect to do well. Tesla's sales per share actually haven't been growing over the last year, and they're still trading at nearly 10 times price to sales. When I started this sorting formula, I actually expected in my mind Tesla to be at the bottom. We'll see if that's true or not, but it doesn't look, the picture here doesn't look as good as the other 6 of the Magnificent 7 stocks, right? Then finally, we've got Nvidia, and this is the one I actually do expect before even performing these calculations. I do expect this one to be at the top because the sales per share growth on Nvidia is absolutely outrageous. And even with this outrageous sales per share growth, the price to sales ratio is still only at 19. A 19 price to sales ratio sounds high. You're trading 19 times sales. Holy crap. But look at the growth. That's why the sorting formula is so important. It's so important to take both into consideration. Anyway, let me perform the calculations and I'll show you the list. So here is the completed list. As I expected, Nvidia with that crazy sales per share growth story is at the top of the list, while Tesla with a little bit of a more stagnant sales per share over the last 12 months is at the bottom of the list. So taking growth and valuation into consideration, this is how I would rank the Magnificent 7 stocks in terms of best to buy down to worst to buy right now. And just to maybe give some validity to what I'm saying here and hopefully to help alleviate the fear of beginner investors maybe going through a correction like this for the first time, in September of 2022, the midst of the 2022 bear market, I tweeted that both Google and Meta are going to make patient people so much money. That tweet on Meta came out right here, and the stock went up over 460% from that point. And on Google, or should I say Goog, that tweet came out here and the stock went up over 100% from that point. The point is, buying these huge mega companies on massive drawdowns like this just isn't a bad idea. Am I guaranteeing you that they will bounce from here? No, of course not. I'm not saying that about any ticker we're going to cover in today's video, but you shouldn't be afraid to buy red. If anything, buying red should be the safer time for you to buy. You're getting to buy these companies at better valuations, which we just looked at when looking at the statistics of the Magnificent 7. Anyway, let's move on from maybe the obvious huge name stocks and let's grind and get into some of the lesser known but still great, amazing setups on some more volatile names. The first stock I want to talk about outside of the Magnificent 7 that I believe is great value right now is DraftKings. Now, I'm not going to talk about DraftKings for very long, and the reason for that is because I own DraftKings stock, and I don't think there's a ton of value in listening to people's bullish reasons once they own a stock, because I'm obviously going to be very biased. It's going to be very difficult, if not impossible, for me to give practical reasons for why you should buy this stock since I'm biased within it. This will be the last stock I cover in today's video that I own any shares of. So we will move forward from this bias, but just look at this sort of same idea we talked about with the Magnificent 7. DraftKings has a very solid sales per share growth story, and the price to sales ratio is very low, currently only trading 3.3 times sales with this growth story. And I just think with the overall optics of sports betting in this country moving forward, I like DraftKings a lot. Let's take a moment in the video right now to talk about some of the most popular stocks that retail investors have been getting into over the last year. First of which being Palantir. This stock was an absolute rocket ship before, of course, getting crushed in this market downturn. Growth stocks like the 3 I'm about to talk about tend to be the stocks that get hit the hardest during market turmoil because they are the stocks that are furthest away from their book value. They have a long way to go down before they get back to true value. So Palantir being the first of them, the next stock being HIMS. Just over the last 3 or 4 months or so, this thing absolutely took off. Of course, over the last month, crushed all the way back down. And then third and finally, another very popular retail stock that I see hundreds and thousands of people talking about online is SoFi. The banking stock flew up over the last 3 months or so and is once again getting hammered. Let's do some quick fundamental analysis on these companies. First, we'll look at Palantir. This thing does have an extremely strong sales per share growth story, but it's got a ridiculously high price to sales ratio. The growth is there, the value is not. Remember when we were looking at the Magnificent Seven, we did that ranking formula so that we could find the best combination of growth and value. I think that's very important. Growth there on Palantir, value not so much, as it's currently trading 71.5 times sales, which is ridiculously high. The next stock we will go and take a look at, actually the second one I listed was HIMS. So let's go take a look at HIMS first. This is another one. Great growth story. Really nice growing sales per share graph. Actually, a very nice, just 4 quarters ago, $4.47 sales per share. Last quarter was $6.29. My quick math is not that good. That seems like it's something like 40% over the last 4 quarters to me. That's very nice. And their price to sales ratio is currently less than 4.5. I actually really like the quick fundamental analysis. Note, we are doing very quick fundamental analysis here in today's video while shopping, but I like this picture for HIMS. Now let's go take a look at the third and final stock being SoFi. Another one, it was growing really nicely. I would say over the last 3 quarters, getting a little bit more stagnant, not like amazing growth. It's actually a little bit surprising to see that sort of big price jump while the sales per share wasn't necessarily growing that much. That's why you see the price to sales ratio here go from just 2.25 up all the way to 4.5 in 1 quarter, because the price jumps huge without necessarily the sales jumping. So you see the big price to sales ratio jump, but now the price to sales ratio is back down to 3. I would say I don't love SoFi, right? Much like Palantir wasn't meeting the value side of the equation, SoFi isn't really meeting the growth side of the equation. So out of those 3 stocks, really the one that I like the most, definitely the one I like the most, and maybe the only one I like at all, is HIMS. I'll just give a little technical warning though about HIMS, and really any of the 3 stocks that I just talked about. They aren't going to move like this again unless they are able to get above these previous highs. The reason, technically speaking, outside of even the fundamental picture we just looked at, that a stock can go up, what is this, 200% in 28 trading days, is because there is little to no overhead resistance, meaning there are no recent shareholders in this area looking to unload bags, looking to get out of the position. There is really no selling pressure to be found here. Whereas now, say tomorrow, the stock market begins turning back up, this is the bottom, everything begins going back bullish. Even if HIMS does bounce, it's not going to just get this rocket ship again, because you're going to have a lot of selling pressure from the people trapped in their positions here. There's a lot of volume during this move. There is a lot of retail traders trapped in very expensive positions on HIMS, SoFi, and Palantir right now that would be very happy to sell if HIMS were to bounce back up into the 40s. Do you know what I mean? So just a little word of caution, technically speaking, even though I like HIMS, even though I might like some of these growth stocks, when they have recent overhead resistance like this, don't expect them to explode unless they are somehow able to get back up and above this high. Once they are above this high, there is once again no overhead resistance, and maybe they can do something crazy again. So now we've kind of talked about all the stocks that I sort of knew the story of already. Now it's time to do some digging. Let's see if we can go shopping and find some new stuff that has good setups for both growth and value moving forward. To do this, I'm going to use my own scanners that I have published over on my website, daytradingstrategies.net. Into our codes, I'm now going to go into the FinViz section. I don't get to talk about this section a lot because this channel focuses very heavily on Thinkorswim custom codes, but I'm going to go into the FinViz section, of course, into screener settings, and let's take a look at both my growth stocks screener and my value stocks screener. Those being two different types of stocks, but both obviously with investing potential. And let's see if any are providing good value right now because of this market correction. So opening up our growth stocks, first up, we've got NVIDIA. We've already taken a look at that one. This is a Cayman Island stock. I'm only interested in USA. So we've got Pinterest, we've got App, down to another USA stock. We've got Cava. Let's go ahead and take a look at the fundamentals of these companies and see if anything looks like it might be worth buying during this dip. First stock on the list was Pinterest, P-I-N-S. So loading up our quick fundamental data here, we can see actually pretty decent growth story. I mean, 4 quarters ago, they were doing $4.70 per share. They're now doing $5.24. That's a pretty solid growth story. And you've got a flat to declining stock price. So the price to sales ratio is only sitting at 5.25. Doesn't like rock my socks. It's not like, oh my God, this is incredible or anything. But hey, solid growth story with, only 5x times sales. Doesn't sound like the worst thing. I don't hate Pinterest. And it's really nice just once again, using a scanner like this. I would have never thought to go look at Pinterest. I mean, Pinterest really the website my wife uses for her recipe ideas and how she wants to get her hair cut. That might be a decent stock. If I didn't have that scanner, I would have never even had this thing on my radar, which is the beauty of custom scanners like this. The next stock I want to look at is APP, App Lovin'. This thing, wow, okay. This thing was an extremely strong growth sales per share company. I mean, it has a very nice growth story, and that was reflected in the stock price as well. This thing over the last year or so has gone from a sub $40 stock up to over a $300 stock. Currently pulling back, of course. Let's actually go look at this thing's actual chart. If we go look at App real quick, yeah, okay. This thing was a rocket ship alongside that sales per share growth story. Of course, now getting over the last 2 months or so because of tariffs and market, everything else, currently getting wrecked. But if I come back in and we take a look, what is the price to sales ratio now? Okay, price to sales ratio sub 20, 19.36. With this kind of growth story, it might not be the worst thing. It's up over 30% in its sales per share over the last 4 quarters. Maybe 30% in a 20 price to sales ratio is not the best. Actually, some of the magnificent stocks we looked at, namely NVIDIA, had a better growth to value ratio than that. But once again, thank you for the scanner. The point of this scanner is to find growth stocks. This certainly is indeed a growth stock, potentially one worth having on the radar. Once again, that is APP. And the third and final stock that I mentioned off the scanner was CAVA. Okay. This is one of those stocks that it IPO'd pretty recently. So it's going to show up on the scanner because, hey, over the last 4 quarters, the sales per share growth has grown. Yeah, that's because it's only been active for 4 quarters. So we'll actually skip over this one. Pretty easy. Whenever you see a stock like this pop up on the scanner, you go, oh, it's just a recent IPO. That's why it's on the scanner. Let's skip it. So back now to the list of scanners. By the way, if you're interested in accessing this list of scanners or the over 140 custom coded scanner study strategies, all within Thinkorswim, they're all available and you get access to all of it for one low price. Daytradingstrategies.net, linked in the description down below this video. Anyway, let's now move on to our value stocks scanner. So the growth stock scanner, for lack of a better term, focuses on growth. It focuses on looking for that increasing sales per share that we look for. The value stocks will be looking more so for that low price to sales ratio. So kind of what we've been talking about, the theme of this entire video is finding stocks that are a good combination of both and each one of these scanners kind of targets one and the other. So let's go ahead and click on this. All you got to do is click on the link. It takes you directly to the free website. You can tell it's free because I get all these ad pop-ups, and the scanner is already running. I see Bank of America. I see Citigroup. So the first two USA stocks on here are banks. Actually, the third USA stock is also a bank, Wells Fargo. The fourth is also a bank, HBAN. Is there a USA? Wow. Okay, interesting. Every USA stock that is on this list out of the first 20 are all banks. So maybe banks are good value right now. I don't know. Let's go take a look. So loading up the first stock on our fundamental page here. By the way, I don't know if I've mentioned this yet. I'm using the free website. It is called Macro Trends. If I actually move this over and make it available here in the top left, you'll see it's called Macro Trends. That's the website that I use to visualize my fundamental data. I'm not associated with them in any way. I just want you all to know what I'm looking at. And once again, since we are looking here at a value stock scanner, what I expect to see is low price to sales ratios. I see a price to sales ratio here on Bank of America of only 1.5. They are only trading 1.5 times sales. And actually, Bank of America has a very nice sales per share growth story to go along with it. This looks really, really nice in terms of our, once again, central topic here being growth and value. Bank of America looks to have a good combination of both. Now, something I will say that immediately kind of draws my attention, since every stock, at least every USA stock on that scanner, was a bank stock, and I'll quickly go ahead and click over to the next one while we talk about this being Citigroup. But since every one of the good value stocks right now is a bank stock, I would want to have more understanding of the banking sector as a whole as it pertains to the macroeconomics going on right now, because maybe there's a reason. I mean, there must be a reason why banks are valued so low right now. I mean, obviously, we've got the tariffs going on. We've got interest rates kind of plummeting right now as well, which is probably, I'm not an economist and I haven't done my research on the banking sector, but I would guess interest rates plummeting is probably why banks are valued really low right now. So when I see an entire sector down, like I see on the scanner like this, I would want to go do more research and I would want to go understand. But hey, banking is cyclical. Interest rates can be cyclical. Maybe right now the sector being down, even if it's due to real reasons, even if there are real reasons for it to be down, doesn't mean it's not a good time to buy it still, right? I just want to make sure I explain that and want to make sure I tell you all my theory crafting when I see, once again, an entire sector down like this. Anyway, Citigroup's price to sales ratio is less than 1. They are trading only 0.7 times their sales, which is crazy, and they're even growing in sales per share. These two banking stocks look really, really good for me as longer term investments, right? These are, when you're talking about value stocks, you can tell from the stock price graph here, they're not going to explode. These stocks aren't going to do 200% in 3 months like we saw HIMSS do, but they can be good, solid investments. And I really like the look, once again, of Bank of America and Citi. Just once again, do your own research and understand your own risk when it comes to investing in the banking sector in a macroeconomic state of falling interest rates. Now let's move back into Thinkorswim scanners, where we can begin to talk about chart setups, more technical setups. The FinViz scanners I was just running focuses on more of the fundamentals, right? The growth, the value of the company. FinViz is better for those kind of scanners. That's why I build them. That's why I publish those there on my website. But for technical setups, we can go back and utilize Thinkorswim. Right now, I am looking at what is called my large cap runners scanner. Essentially, I am looking at stocks that are obviously large market cap stocks over 500 million and very strong on their daily chart. And I also have turned on a custom column that I have built and published over on the website that shows us the percent change from the 52-week highs. I sort descending top down by that. I can see the stocks on this list that are the closest to their 52-week highs. So essentially, what are the largest market cap stocks in the market right now that are the strongest? The list right now is really short. There's only 13 stocks that even match my scan filters for this because, of course, the market's getting crushed. It's hard to find strong stocks right now, but we do have a couple. We have at least three here that are within 5% away from their 52-week highs. The first being TJX. If I go ahead and load up the TJX chart, we can see, look at this. Even though the market's been getting crushed over the last month, TJX is up a nice 13% and actually sort of testing, if we once again want to have the conversation about technicals, it is testing a high level here. If TJX can get up and break over that 128 level as, once again, a purely technical setup, especially in this weak market, when a stock is showing this kind of strength while the overall market is this weak, that means the stock is something special. That means the stock is very, very strong. So if this thing can get up over 128, and especially if it does it alongside the market going through an upturn, keep an eye on TJX. The next stock we'll take a look at is ADT. Let's go ahead and load up ADT. I actually already have a line on this one, maybe doing some technical analysis, but here's another one. Once again, market's been getting crushed over the last 2 months. That's not so bad. ADT is up over 15% in the last 30 trading days. It's doing its thing. There are always, I repeat, always opportunities to make money in the stock market. No matter what the stock market's doing, if you have the right kind of scanners, you can still find bullish setups. ADT, once again, pretty similar setup to TJX, technically speaking. Stock that's been strong in a weak market that is double topping at a high level here. Once again, another one. Technically speaking, you could potentially watch for a breakout, especially if the overall market decides to turn up. Third and final on this scanner we'll look at is HDB. Pretty similar story. I am seeing a stock running into or close to at least some resistance zones here. You've got a zone where 1, 2, 3 times it has rejected out of. Actually, 4, you can call this a rejection. And even though the market's been really weak over the last month or so, HDB is once again up 15%. So some pretty similar setups there, but those are 3 technically strong names that you can keep on a watch list somewhere. They are performing well even while the market is getting hammered. Now let's get into the big boy, the one you've all been waiting for, the stock that I truly believe has potential to be a very high multiplier within people's portfolios. Let's go ahead and take a look behind the curtain a little bit first at the numbers of this name before I reveal the company to you. I got to keep you guessing a little bit, right? What's been the central topic once again of this video? Strong, growing stocks with solid valuations. This company over the last 4 quarters has gone from $16.20 sales per share up to $33.30 sales per share. That is 100% plus growth in their sales per share over the last 12 months. And their current price to sales ratio is less than 1. Ridiculous value for this growth story. This growth story looks a lot like NVIDIA. It's not, actually, NVIDIA was like 116% over the last 12 months. This might be like 105, 110, right there alongside the NVIDIA growth story. And trading at less than a 1 price to sales ratio is ridiculous. Now, if we come over and look at its Yahoo Finance page, we can see here $19 billion market cap. There's that less than 1 price to sales, only 3 times their book value. And if we come down as well, once again, remember $19.1 billion market cap. They've got a yearly revenue of $20.8 billion. Their yearly revenue is more than their market cap. And if I continue down here, we can see they've got a debt of $1.96 billion, but they've got $1.43 billion in total cash, and their EBITDA, meaning their income after most expenses this year, is at $1.6 billion. So they've got, in my eyes, and once again, a very quick fundamental analysis, they've got very strong books. And I think I did reveal the name during this scroll down here. The name is, in fact, SMCI. If we go ahead back into our Thinkorswim and type in SMCI, this might be a name that a lot of you all are familiar with because this was a name that went absolutely crazy. And once again, for good reason. you saw the growth story. Much again, it looks just like Nvidia. Ridiculous growth story. It went berserk for good reason. Now it's crashed also for good reason. Things in the stock market don't happen for no reason. I give, full validity to the reason it crashed, and that is because they were behind on some financial reports. One of their auditors ended up getting fired. They came actually pretty close to getting delisted from the NASDAQ because they weren't meeting the regulation requirements and getting their filings in on time, which is extremely bad for a company. Extremely bad. There's no denying that. That is why this stock got crushed. But since February, so since about a month and a couple weeks ago, they've gotten their filings in. Everything looks to be good. They look to be back within NASDAQ regulations now. So I am willing to take the risk on a name like this. On that growth story and ridiculously low valuation and the solid cash and EBITDA to debt books that we looked at, I'm willing to take the risk that they slipped up. They screwed up massively. Once again, don't get it twisted. I'm not trying to say like, oh, they didn't deserve it. Oh, no, they screwed up massively. Not getting your filings in on time and almost getting delisted is horrible from a company, but you can't deny that growth story. I love buying that growth story and that value and taking on that risk that they screwed up once. Hey, they fudged it up. Hopefully they're not going to do that again. I think the risk to reward is worth buying this though. And let's take a look back at some other names too. Let's take a look here at Nvidia. This stock in 2021 was ridiculously strong, went on a very, very strong multi-100% move, then got absolutely crushed in 2022. And much like I mentioned earlier, isn't going to explode like that again. It's got this overhead resistance now, right? So it's not going to explode like that again. Grinds, has a really good earnings. Once it gets back up above this level, obviously begins exploding again. Let's go take a look at another stock in the similar sector. If you don't know, by the way, I don't know if I mentioned yet, SMCI is in the same sector as Nvidia, as AMD, in this semiconductor GPU sector that, of course, with the explosion of AI is all exploding right now. But anyway, look here, Nvidia or AMD, once again, strong move, got hammered, grind. Once it got back above this high, exploded. Really strong move, got hammered again, grinds. Once it gets above this high, explodes. So there's examples of it happening as well. Once again, in stocks in the same sector of a strong move, getting run down. Let's see if this thing now can grind back up. And it's currently trading at $28. Its local high is all the way up at $120. That would be a 6x just to get back to highs. And I think it's possible. I'm not saying it's going to happen. Of course not, but I think it's possible. SMCI could see that grind back up as long as that growth story continues, as long as they don't fudge up their regulatory paperwork anymore, grind back up and maybe get that explode through highs like we saw multiple times on the AMD and Nvidia charts within the same sector. If you're interested in making use of any of the scanners you've seen in today's video so that you can always find the types of stocks that we found today, once again, make sure you go sign up to my website, daytradingstrategies.net, where once you sign up, you get access to all 140 plus custom codes for only $35 a month. And since you watch this entire video, I'll even give you a little extra bonus if you use discount code END. Your first month is only $25. That's something like 17 cents a code or something ridiculous like that. I do have it set up as a subscription, as I am always adding and updating new codes to the website so that we can always remain on top of ever-changing market conditions. But if you would like to just sign up, download some strategies, download some scanners, then cancel, you can do so with just 3 mouse clicks under the My Account tab. I don't make it difficult. I promise you can cancel very easily. So don't feel like you're going to get locked in. Anyway, daytradingstrategies.net, link down below. Go check out the site, at least read the reviews, help decide for yourself if it's something that can help accelerate your trading journey. Hopefully you all learned something in this video, whether it was, an idea of a stock that I mentioned that maybe you're going to add to your watch list, or maybe just the overall idea of what I look at when I'm doing my shopping for stocks. Hopefully you learned something. Hopefully you got some new ideas from this video. If you did, please take the half second to hit the like button. If you would like to continue learning, make sure you subscribe to the channel by clicking the red subscribe button down below. That's completely free. Why wouldn't you do it? And with all that being said, I'm going to go ahead and sign out of this video, and I'll catch you all in the next one.